Gold has collapsed before, not once, not twice, but repeatedly across modern financial history. Each time, the explanation sounds familiar. Prices moved too fast, liquidity dried up, investors panicked, external shocks triggered sell-offs. These explanations are not wrong, but they are incomplete. They describe what happened without explaining why it happened in that particular way, at that particular moment, among people who believed they were holding something fundamentally different from ordinary financial assets. Gold occupies a unique position in the human imagination. It is not just a commodity, not just a store of value, and not merely a hedge against uncertainty. For thousands of years, it has functioned as a symbol of permanence in systems defined by impermanence. Empires fell, currencies vanished, institutions dissolved, and yet gold endured. This long memory shapes how people relate to it today. When individuals buy gold during uncertain times, they are often responding to more than price signals or macroeconomic indicators. They are responding to a deeper narrative about safety, continuity, and trust. Yet history shows a paradox. In moments of extreme stress, gold has sometimes fallen sharply alongside the very systems it was meant to stand apart from. During financial crises, periods of intense deflation, or sudden liquidity shortages, gold prices have declined even as confidence in banks, governments, and currencies deteriorated. To many observers, this appears contradictory. If gold represents trust beyond institutions, why does it falter precisely when institutional trust breaks down? To explore this question, it is necessary to move beyond the idea of gold as a static safe haven and instead examine it as part of a dynamic system shaped by human behavior. Markets do not merely reflect value, they reflect belief. Prices are not just numerical outputs. They are expressions of collective confidence, fear, and coordination. Gold markets, despite their ancient symbolism, are not immune to these forces. In fact, their perceived role as a refuge may make them more sensitive to shifts in trust, not less. The phrase gold market collapse often suggests a failure of the asset itself. But historically, what collapses first is not gold's physical existence or its industrial usefulness. What collapses is the shared belief about how gold will behave when other systems are under strain. This belief is not written into law or guaranteed by nature. It is a social agreement, reinforced by memory, narrative, and repeated expectation. Trust, in economic terms, is rarely absolute. It operates on layers. People trust money because they trust institutions. They trust institutions because they trust legal systems, enforcement mechanisms, and social norms. Gold appears to bypass these layers, offering something tangible and independent. But in modern markets, gold is rarely held or exchanged in isolation. It is embedded in financial structures, futures contracts, exchange-traded products, leveraged positions, custodial systems, and global liquidity networks. This embedding changes how gold behaves under stress. When financial pressure intensifies, market participants do not simply ask whether gold has value. They ask whether gold can be converted, liquidated, or mobilized quickly enough to meet immediate obligations. In these moments, the question shifts from long-term preservation to short-term survival within the system as it currently exists. Assets that are theoretically safe may be sold not because they are distrusted, but because they are trusted to retain enough value to cover urgent needs. This distinction is subtle, but important. A collapse in gold prices during a crisis does not necessarily indicate a loss of belief in gold's long-term role. It often indicates a breakdown in trust between market participants about timing, coordination, and liquidity. When everyone believes that others will sell, holding becomes risky regardless of fundamentals. Trust erodes not in gold itself, but in the behavior of other holders. Historically, episodes of gold market stress tend to coincide with broader moments of systemic strain. During the Great Depression, gold's role was reshaped by government intervention and shifting monetary regimes. In the 1970s, gold surged amid inflation and currency instability, but also experienced sharp corrections as policy expectations changed. In the global financial crisis of 2008, gold initially fell alongside equities as investors sought cash, before later recovering as monetary responses unfolded. Each episode reflects a different configuration of trust, fear, and institutional response. What these cases share is not a simple pattern of gold rising or falling, but a pattern of belief adjustment. People reassess what gold represents relative to other assets, obligations, and expectations. They test assumptions that may have gone unchallenged for years. In calm periods, gold's meaning feels settled. In crises, it becomes contested. This contestation is amplified by modern market structures. The majority of gold exposure today is not physical. It is mediated through financial instruments that depend on counterparties, clearing mechanisms, and regulatory frameworks. These layers introduce new forms of trust and new points of failure. When confidence in financial plumbing weakens, the behavior of gold prices reflects those stresses, even if the underlying metal remains unchanged. At the same time, cultural memory continues to influence expectations. Stories of gold preserving wealth during past collapses circulate widely, often without nuance. These stories shape behavior, encouraging people to view gold as a final anchor. But when reality does not immediately align with narrative, disappointment and confusion follow. This gap between expectation and experience is where trust becomes fragile. Understanding gold market collapses, then, requires examining how trust operates at multiple levels simultaneously. There is trust in gold as an object, trust in markets as mechanisms, trust in other participants' behavior, and trust in the broader economic environment. When these layers align, gold appears stable. When they fracture, volatility emerges. At this point, it becomes necessary to look more closely at specific moments when gold's perceived role was tested, and how human behavior, institutional constraints, and psychological responses interacted to produce outcomes that seemed, at first glance, irrational. The surface explanation lies in price movements. The deeper explanation lies in how trust is formed, strained, and sometimes withdrawn under pressure. When gold prices fall during periods of systemic stress, the immediate explanation often points to technical forces, margin calls, liquidity shortages, or shifts in interest rate expectations. These mechanisms are real, but they operate within a broader behavioral environment. To understand why gold market collapses recur, it is necessary to examine how trust behaves under constraint, and how financial actors respond when their assumptions about coordination begin to fail. One of the most consistent features of financial crises is the sudden revaluation of liquidity. In stable conditions, liquidity is taken for granted. Assets are assumed to be convertible at reasonable prices, and timing is assumed to be flexible. During crises, this assumption collapses. Cash, or near-cash instruments, becomes disproportionately valuable because it satisfies immediate obligations. This creates a hierarchy of assets based not on long-term value, but on short-term usability. Gold often occupies an ambiguous position in this hierarchy. It is widely viewed as valuable, but not always as immediately usable. Physical gold requires storage, verification, and transportation. Financial gold, held through derivatives or funds, depends on intermediaries. When trust in intermediaries weakens, holders may rush to convert positions into cash, even if they believe in gold's long-term role. The act of selling, in this context, is not a rejection of gold's value, but a response to systemic pressure. This dynamic was visible during the early phase of the 2008 financial crisis. As credit markets froze and institutions scrambled for liquidity, gold prices declined alongside equities. Investors sold what they could sell, not necessarily what they doubted. Gold was liquid enough to be monetized, unlike certain structured products or illiquid assets. The decline reflected a scramble for cash, rather than a reassessment of gold's ultimate worth. Once central bank intervention stabilized funding markets, gold recovered, reinforcing its longer-term narrative. But the initial drop left a lasting impression, revealing how fragile the coordination around gold can be. Coordination is a central concept in understanding trust collapses. Markets function because participants share expectations about how others will behave. When these expectations are stable, even volatile assets can trade smoothly. When expectations fracture, prices can move abruptly. Gold markets are particularly sensitive to this because they attract participants with heterogeneous motives. Some view gold as insurance, others as a hedge, others as a speculative asset. In calm periods, these motives coexist without conflict. In crises, they collide. Insurance holders expect gold to rise when other assets fall. Speculators expect volatility. Hedgers respond to macroeconomic signals. When gold does not immediately behave as expected, each group interprets the deviation differently. Insurance holders may feel betrayed, speculators may accelerate selling, and hedgers may reassess correlations. This divergence amplifies uncertainty about future price movements, weakening trust in the collective behavior of the market. Historical examples illustrate this process. In the early 1980s, after a decade of high inflation and geopolitical tension, gold prices peaked and then declined sharply. The collapse was not triggered by a single event, but by a shift in expectations about monetary policy and inflation control. As confidence in central banks increased, the narrative that had sustained gold's rise weakened. Trust migrated back toward institutional frameworks, reducing gold's relative appeal. The price decline reflected not a sudden discovery that gold lacked value, but a reallocation of trust. A similar pattern emerged during periods of disinflation in the 1990s. Gold underperformed as markets increasingly trusted fiat monetary regimes and financial innovation. The absence of visible crises led to complacency about systemic risk. In this environment, gold's symbolic role faded, and with it, the coordination that supports higher prices. When trust in institutions is strong, trust in gold as a distinct refuge often diminishes. This inverse relationship highlights a key insight. Gold's value is relational, not absolute. It depends on what it is being compared to and what people believe about the stability of alternatives. When trust in institutions erodes gradually, gold may rise steadily. When trust erodes suddenly and violently, the immediate response may be confusion rather than flight to safety. In such moments, participants are unsure which form of trust will hold. Modern financialization adds another layer to this uncertainty. Gold markets today are deeply intertwined with leverage. Futures contracts, options, and exchange-traded products allow participants to gain exposure without holding physical metal. These instruments magnify price movements and introduce forced behavior. Margin requirements do not respond to belief. They respond to volatility and price changes. When prices move against leveraged positions, selling becomes mandatory, regardless of conviction, that this mechanical selling can trigger feedback loops. Price declines lead to margin calls, which lead to further selling, which reinforces the perception that something is wrong. Observers may interpret the price movement as a signal of declining confidence in gold, even if the underlying cause is structural. Trust erodes not because of new information about gold, but because of visible instability in the market. The role of institutions in shaping trust is also crucial. Central banks, governments, and large financial actors influence perceptions through their actions and communication. When authorities intervene decisively during crises, they can restore confidence in monetary systems, reducing the perceived need for alternative stores of value. When interventions are delayed or contested, uncertainty persists. Gold's behavior during these periods reflects not only economic fundamentals, but interpretations of institutional credibility. For example, during periods of aggressive monetary easing, some market participants interpret policy actions as supportive of gold, while others see them as stabilizing forces that reduce systemic risk. These conflicting interpretations create divergent strategies, weakening coordination. Price volatility increases as participants react to each other's moves rather than to a shared understanding of the environment. Behavioral research suggests that humans are particularly sensitive to violations of expectation during stress. When an asset fails to perform its expected role, confidence can deteriorate rapidly. This does not mean that belief disappears entirely. It means that belief becomes conditional. Participants begin to question not whether gold has value, but under what circumstances that value will be recognized by others. This conditionality is the core of trust collapse. Trust is not the absence of doubt. It is the willingness to act despite uncertainty. When participants are no longer willing to rely on shared assumptions, markets fragment. In gold markets, this fragmentation manifests as abrupt sell-offs, sharp rebounds, and prolonged periods of indecision. Importantly, these dynamics do not resolve quickly. Once trust is strained, it takes time for narratives to stabilize. Participants watch each other closely, looking for confirmation that a new equilibrium has formed. During this period, gold may behave erratically, reinforcing the impression that it has lost its anchoring role. In reality, what has been lost is not value, but consensus. At this stage, the pattern becomes clearer. Gold market collapses recur not because gold repeatedly fails, but because the trust structures surrounding it are repeatedly tested under changing conditions. Each crisis redefines what participants expect from gold, and each redefinition carries the risk of misalignment. To understand why this keeps happening, it is necessary to step back and examine how trust itself evolves over time, and what gold represents when systems move from stability to stress and back again. Trust in economic systems is rarely rebuilt in the same form in which it was lost. It adapts, fragments, and reassembles around new assumptions. Gold's recurring pattern of apparent failure and recovery reflects this process. Each episode of stress reshapes the collective understanding of what gold is meant to do, and just as importantly, what it is not meant to do. One of the most persistent misunderstandings surrounding gold is the expectation of consistency. Gold is often described as timeless, but the systems in which it operates are not. The monetary regimes, market structures, and behavioral norms that surround gold change continuously. As these contexts shift, the way trust attaches to gold also shifts. What appears to be a collapse is often a transition between different trust configurations. Over long periods, gold has served multiple functions: a monetary anchor, a reserve asset, a symbolic store of wealth, and a hedge against extreme outcomes. These roles are not always compatible in the short term. During stable periods, gold's relevance may fade as trust concentrates in institutions and financial instruments. During unstable periods, gold's symbolic role re-emerges, but the path from symbolism to price is mediated by modern market realities. The gap between expectation and mechanism is where disillusionment arises. This gap is particularly evident when comparing physical and financial gold. Physical gold represents continuity and tangibility, but financial gold represents access, speed, and integration into the broader system. In practice, most market participants interact with the latter. As a result, gold's market behavior increasingly reflects the logic of financial systems rather than the mythology of permanence. Trust in gold becomes inseparable from trust in the infrastructure that supports its trade. When that infrastructure is strained, gold prices can behave in ways that feel counterintuitive. This does not negate gold's historical role, it reframes it. Gold does not stand outside human systems. It exists within them, subject to the same coordination problems, incentive structures, and psychological pressures. Its durability lies not in immunity to stress, but in its ability to regain relevance after stress has redefined priorities. Historical patterns support this interpretation. After major crises, gold often enters a period of reassessment rather than immediate vindication. Participants revisit assumptions about monetary stability, institutional credibility, and long-term risk. Trust does not flow back to gold automatically. It competes with renewed confidence in reformed systems. Over time, as memories of crisis fade or as new vulnerabilities emerge, gold's role is renegotiated once again. This cyclical renegotiation explains why gold market collapses continue to occur without resolving the underlying debate about gold's value. Each generation inherits narratives shaped by past experiences, applies them to current conditions, and adjusts them when reality diverges from expectation. The result is not a linear progression toward clarity, but a recurring process of belief formation and correction. From a psychological perspective, gold functions as a reference point for uncertainty. It provides a way for people to think about stability when other signals are noisy or contradictory. But reference points are not guarantees. They help orient decision-making, not eliminate risk. When too much certainty is projected onto gold, disappointment becomes more likely when outcomes fail to align with simplified narratives. The broader implication is that trust in money systems is inherently dynamic. No asset, institution, or framework holds trust permanently. Trust is earned, tested, and withdrawn based on performance, perception, and context. Gold's long history gives it resilience in this process, but not exemption. Its repeated failures are better understood as moments when collective expectations outpace structural realities. This perspective also reframes the idea of safe havens. Safety is not a fixed attribute. It is a relationship between perceived risk and available alternatives. When risks are clearly defined and institutions respond predictably, trust concentrates. When risks are ambiguous and responses are contested, trust disperses. Gold's behavior across different crises reflects these shifts rather than contradicting its historical role. In the present, gold continues to occupy an uncertain space. It is neither fully integrated into modern monetary systems nor entirely separate from them. It carries symbolic weight, but trades through highly technical mechanisms. This duality ensures that debates about its role will persist. As long as financial systems evolve and new forms of money emerge, gold's meaning will remain contested. Looking forward, it is reasonable to expect that future episodes of stress will once again test assumptions about gold. Some participants will interpret price declines as evidence of failure, others as temporary distortions. Both interpretations will draw on selective readings of history. What will matter, as it always has, is how trust reallocates across systems in response to changing conditions. Ultimately, gold market collapses are not anomalies to be explained away. They are expressions of a deeper truth about how humans relate to value under uncertainty. Gold does not fail because it lacks worth. It falters when the trust structures around it become unstable, and when those structures stabilize or reform, gold's role is reassessed, not resolved. In this sense, the repeated cycles of rise, collapse, and recovery are not signs of contradiction. They are signs of continuity. They reveal that gold's true function is not to provide certainty, but to serve as a mirror for shifting beliefs about money itself. As long as trust remains the foundation of economic systems, gold will continue to reflect its fractures as clearly as its strengths. If you want to continue examining how trust, psychology, and historical patterns shape the way money succeeds or fails, this channel explores those questions through documented cases rather than predictions or advice. Future episodes will trace how belief migrates between currencies, assets, and systems over time, and what those shifts reveal about human behavior under uncertainty.